Hi, I'm Bill Boersma. This is a companion piece to a recent video I put together about refinancing policy loans. Over the years, I have clearly learned that people pay attention when they listen to war stories. So here we go. One important thing to remember is that it's not always about how a policy is doing today, but about how a policy will be doing in the future if nothing is done. Many years ago, I was brought a second to die whole life policy with a $5 million death benefit. The contract was originally sold to a couple with a $40,000 annual premium on a 10-pay basis. As is all too common, these people understood the 10-pay to be the deal and not just a projection. They referenced their policy as, quote, paid up. As would be sensible, they stopped paying the premium in the 11th year, only the policy didn't stop needing annual premiums. It was just a matter of where those premiums came from. When they didn't pay premiums out of pocket, the policy borrowed the premiums from the insurance company. Too many policy owners simply understand this as, quote, using internal policy values to pay the premiums. Paying premiums through policy values is very different than paying premiums through policy loans. And if a policy owner doesn't understand this, it's easy to understand how he could get in trouble. When I ordered an in-force ledger, I saw that down the road, but well within life expectancy, the premium column, which had been zeros for decades, all of a sudden had numbers reappearing. The numbers were $400,000 a year, 10 times the annual premium originally paid. $40,000 of it was actual premium with $360,000 of loan interest. For simplicity, I'm calling this premium. Furthermore, the death benefit that had been projected to grow had now shrunk to $3.5 million and kept on shrinking with every $400,000 premium payment. The clients told me that if they got to that point, they simply wouldn't pay that premium, but I told them they didn't really have that option. At that point, the policy would collapse with more than $10 million of taxable gain at ordinary rates. Furthermore, it'd be phantom gain. This is the way it works, and I've seen it happen before. I worked with a family who was literally bankrupted by a collapsing life insurance policy. In another situation, a gentleman had a $2 million mutual whole life policy with greater than an $800,000 loan. With a policy loan rate at 8%, the accruing debt and an additional year of premium would increase the loan by $100,000 just this year. We looked at multiple internal policy management options, as well as looking to other carriers and products. Ultimately, we looked to external premium loan refinancing, and modeling showed that a newly unencumbered policy with a changed dividend option could not only support itself without premiums paid out of pocket, the dividends were enough to cover the interest on the external loan as well. An elderly couple with a survivor whole life policy was in a similar situation. They hadn't paid premiums out of pocket for a number of years, while the loan spiraled out of control simultaneous with the dividend rate dropping. We changed the dividend option, which slowed the deterioration of the policy, but it simply couldn't salvage it. An external loan refinance, however, did make a dramatic difference. With the loan paid off, the policy could cover premiums with dividends, and additionally, there were enough paid-up additions that could be surrendered to pay the interest on the external loan with nothing come out of pocket from the clients. This ended up saving a tremendous amount of cash flow and salvaging a couple million in death benefit. In my final case, I have a gentleman with a whole life policy through a top-rated mutual carrier. His $1.1 million in policy loans represents 93% of the gross cash value. We're going to have the exact same issues to deal with, and I'm confident we can bring him some solutions. In these situations, the quality or name of the carrier simply doesn't matter. It's affecting these policies the same across the board. Whether the solution is maintaining the status quo, changing up policy management, bailing on a contract, exchanging it for a new policy, paying the premium, loan interest, or loan principal out of pocket, or externally refinancing it, there is a best solution for any given situation, and it pays to spend the time and money and effort to find it, independently and objectively. Short of the insured being at death's doorstep, burying your head in the sand isn't going to accomplish anything. We're here to help. We look forward to talking.